Eazl.
So a bond is basically a group loan when individuals and banks and other organizations, investors, they get together and make a big loan to some organization that needs money. It could be a government, it could be a company, etc. Now, the key components to a bond are the maturity date, that's when the bond has to be paid back, and the coupon rate, that's the interest that you as an investor will earn from this bond. So here's a quick example. If there's a $1,000 bond at 30 years at 7% that's given to some company, that means that basically the investors are going to be paid $70 a year, and in 30 years, that company is going to pay the $1,000 back to investors. So basically, the money that investors have made in that situation is that $70 over the 30 years. Now, bonds can be traded. So if you as an investor hold a bond, you can sell it and you might actually lose or gain money on that bond. What it's worth at a given moment is called its par value. So, for example, if you bought that bond for $1,000 and then interest rates in general go down, your bond might be worth, say, $1,020 now. That's because interest rates are the main factor that impact the value of bonds. If investors can't get as much interest from a new bond, then the bonds that have those higher coupon rates are going to be worth more money. Here are 3 summary points on bond strategies. First, short and medium-term bonds, those that have a maturity date of like 1 to 3 years, they tend to produce the most income for you as an investor. A longer-term bond is best for capital gains. So if interest rates are pretty high, you buy a bond that's 30 years long, then over time, it's likely that at some point the interest rates are going to go down and that bond might be worth more money on a par value basis. It's also important to note that you can lose money on bonds. For example, if you buy a bond that has a low interest rate and then interest rates go up, that means that the value of your bond is going to go down. Conversely, if interest rates go down, the value of your bond goes up. So in summary, you can think of a bond as a big group loan to some organization, and you take a part in that loan. The key components are the maturity date, that's when all of the investors get paid back, and the coupon rate, which is the interest that that organization will pay for renting the money over time. Finally, bonds can be traded, and the biggest impact to a bond's value tends to be the current interest rates in the market.